This is a lecture from OpenTuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
So there is an accounting standard that deals with your earnings per share. So even though it's one of the ratios, and we'll talk in more detail about the ratios in the following few chapters, earnings per share is such an important accounting measure that it has its own standard. Okay, so what is it all about? Why does it actually have its own standard? Well, the name of the chapter, earnings per share, is very literal. We will go through there and take the earnings that a business makes, so its profits for the year, and then we will go through there and divide it by the number of shares. So here, the earnings belong to the ordinary shareholders, so we're going to divide those earnings by the number of equity shares that are in issue. Okay, now the formula that you've got there for this basic earnings per share makes it look a little bit more long-winded than just taking your profit for the year divided by your number of shares, but I'll come to that in a moment as we then work through the example. But I just want to go through there and identify why it's important to calculate this EPS figure, not just to focus on your earnings, your profit for the year, that big headline figure that we see within the financial statements, but we should have more of a focus on this earnings per share figure. So let's go through and have a look at a brief illustration. So we've got there, is it the profit for the year? So that's your earnings. And then we're going to look, is it at the number of shares that are in issue? And we're going to look at it, is it for 3 years? Years 1, 2, and 3. Okay. Let's just say that my profit for the year in year 1 is 100. And the number of shares that are in issue are 200,000. If that's the case, then the earnings per share, one divided by the other, is 0.5 per share. If the profits for the year in year 2, pardon me, go through there and increase to 120,000. If we go through and look at it on a year-for-year earnings basis, we can see that the business has performed better overall. That headline figure looks great. And the good thing is here is if you look at the number of shares, there's been no issues of shares. So therefore, what you've got there, 120 divided by the 200, that gives me now, is it $0.6 per share. Okay, so there's been an increase in your earnings per share, as well as an increase in the profits for the year. And it's a comparable increase in both of them. So at that point there, you think, well, I don't really need to work out the earnings per share because I can see that increase in the EPS as the same increase in the profits for the year. However, let's just say that in year 3, there is a massive increase in the earnings. Is it there at $260,000? Well, if there's an increase in earnings of $260,000, automatically you look at that and go, wow, what a fantastic performance that actually is. But if you go through there and have a look at the number of shares that are now in issue, we have 400,000. So maybe what's happened there is that there's been an issue of shares. And that issue of shares has been for cash. So it's some form of some form of rights issue or new issue of shares. If it was a bonus issue, there wouldn't be any cash. And what you can see there is that if we now work out my earnings per share, you get a better reflection of how this company has performed. Because what you've got there is that the profits have increased pretty exponentially, haven't they? I think if you work it out, it's about a 116% increase in your profits for the year, your earnings figure. So that looks truly outstanding. It's a really good improvement in the profits, but the underlying reason for the improvement in the profits is that you've gone through, you've issued more shares, you've raised more finance. That finance has been used to improve the profits of the business. So investing in some new project that's generated you increased sales and increased profitability. So when you go through there and look at the impact that the number of shares have had on the profits, it has had a positive impact, but maybe not as much as what you would initially have considered. Okay, you've gone through there, you've raised 200,000, or you've issued 200,000 more shares. That's raised you more cash, it's increased the profit, and it has also increased the earnings per share. Okay, so you need to be a bit careful, because if you look at it in a similar fashion, you've seen there that the EPS has increased each year. Imagine it if we just changed it. Let's just go through there and change the figures for year 3. Let's just say, that the profits went up to 220,000. On the face of it, that looks good, doesn't it? You've got there an increase in your profits. They've nearly doubled, haven't they? Everybody would be really, really happy. Fantastic. Well done. Big pat on the back. But if you look at it from an earnings per share figure, then what you've got there is it's not as good as what was expected. The earnings per share figure is 0.55. Okay. So the actual earnings per share is worse than the previous year. So therefore the performance isn't as good as what would have been expected. So this business has raised equity finance. Great. It's used it to increase the earnings. Great. But it hasn't used it well enough to create enough earnings to counter that additional number of shares that are in issue. The shareholders are effectively worse off than what they were previously. Okay. So you've got to be very careful when you're particularly analysing the financial statements, that you don't just focus on that headline earnings figure, but you go through there and calculate this very clever earnings per share figure. And it's for that reason then that we need to look at the rules, particularly within the accounting standard. Because when we're looking at basic EPS, we'll go on to look at diluted EPS later. Basic EPS just takes account of the earnings that you have made in the current year and the number of shares that are in issue during the current year. It doesn't take account of any future changes in earnings. It doesn't take account of any future changes in shares that might potentially happen, which is what we'll do when we get to diluted earnings per share. Basic EPS takes our profits, our earnings that are made this year, and divides it by a number of shares. But we just need to be careful, because when we're looking at the profit, yes, we're looking at our profit for the year, but that profit needs to be attributable to the ordinary shareholders. So it can't be attributable to any of the preference shareholders. It can't be attributable to the non-controlling interest. You need to look at the profit that belongs to the ordinary equity shareholders. Likewise, in terms of the number of shares, you can't just work out the number of shares at the end of the year. You need to look at a weighted average number of shares. Because when you're going through and looking at your weighted average number of shares, share issues will take place at different parts during the year. So if there's been a share issue at the very start of the year and you've raised cash for it, then that cash that you will have raised will have had a full impact on the profits for the year. But the later you issue the shares within the year, the less of an impact that will have on your earnings. So therefore we need to make an adjustment based upon when the shares were issued, so that we're matching up the number of shares in issue during the year to when those increased profits were actually made. Okay, so we're going to do a weighted average, and that weighted average is based on a number of months. Likewise, when we're going through there and looking at the types of share issues, there are 3 different areas that we will need to consider. Businesses can issue equity shares at full price. They can go through there and issue them as a bonus issue. So that's going to be a bit complicated because there's going to be no cash impact And if there's no cash impact, there can't be any impact on our earnings, but there will be an impact on the number of shares. So what adjustments are we going to make there? And then we're going to go through there and look at a rights issue. So we're not issuing the shares at a full price. We're issuing them at below their full price, so that their market value, in order to incentivize the shareholders to take up the rights. But again, that's going to have an impact on some of our calculations. So what we see is that we've just gone through and looked at the understanding about why we need an earnings per share figure. But the chapter itself is very much all about crunching the numbers. And if you can crunch the numbers well, then you'll be able to answer any of the questions in section A well, with regards to one multiple choice question. There could be an entire section B question on EPS, potentially. And then you could also have a very small part of a published company accounts or group accounts question for 3, maybe 4 marks max, just about earnings per share. So having prepared the group statement of profit or loss, having prepared the published company accounts, using your answer, you might have to work out an earnings per share figure. So it can effectively appear anywhere within the exam.